As we stand today, in multifamily, we have a pipeline of 4,500 multifamily units, of which just over 3,000 homes will have been delivered by spring of next year. So that's pretty significant in the grand scheme of things in the UK. I think there was some headlines recently about no one's reached the kind of optimal 5,000 homes, but we're getting close, and it's a steady kind of growth path to get to that kind of level. Initially, the business was private equity led, Middle Eastern capital, and develop schemes to core, operate them for a period of time, and then dispose of them. Clearly, within multifamily, it's been a bit more of a programmatic relationship with our development partner, and we jointly operate those assets with them taking the branded sort of customer-facing piece, whereas we're dealing with a lot with the investors, but the asset management is very hands-on from those assets.
Welcome to the People Property Place podcast. Today we are joined by Ashley Perry, otherwise affectionately known as Panel Perry, Investment Director at Apache Capital, to the podcast this week. Ashley is responsible for supporting the Apache multifamily BTR platforms, where he take a key focus on the origination of new investment opportunities and driving growth across the business. He takes a key lead with the development and investment partners on deals and market analysis, underwriting, and transactions. Prior to this, he worked at Cortland Consult as a director in their BTR consultancy, and JLL latterly as a senior project manager. As well as his day job, Ashley is the vice chair of the UKAA Investor-Lender Forum and sits on the ULI UK Residential Council Leadership Group. And as you may have figured out by his nickname, he sits on several industry panels where he shares his thoughts, views, and opinions on the market. Ashley, Podcast Perry, welcome to the show.
Thank you very much.
Not at all. Well, look, we'll come on to your role at Apache, how you see the market, where the opportunity is. But a place that I always like to start these podcasts is, how did you get into real estate? Because I think you're the first person in over 10 years of me doing this that studied forestry at university.
Yeah, that's right. So I grew up in west coast of Canada, partial British background, hence the rather strange accent. But I was in the forestry program at University of British Columbia, where in Western Canada, it's the only place you can sort of get in as a direction into, use that as a platform to get into architecture. I really wanted to be an architect and sort of saw wood science and engineered wood and timber as an area that I really wanted to focus on about 16, 17 years ago. And I was encouraged by a sort of career advancement person at my school to get into that. Turns out it wasn't for me. So I did a technology diploma at British Columbia Institute of Technology, and that was architectural building engineering. And then that led into being very applicable into my first role, which was with a quantity surveying company in Vancouver.
So where did property come into the frame in terms of a career or a route that you wanted to?
I guess from my perspective, I always liked the built environment. And when I got my first internship, which was all of 1 week with a company called BTY Group based in Vancouver, I took the bull by the horns and realized that was really interesting, and what they were doing there around actually working with some of the financiers of residential developments as a project monitoring lead. So I took that on, and at the end of the first week, they just turned around and said, how about moving to Saskatchewan, which is in the middle of Canada, if people don't know their geography. It's not a place you would necessarily choose to visit if you were coming to Canada as someone on their holidays. But I took the bull by the horns in that summer and went out there for 3 months to kind of kickstart the growth of the Prairies business for BTY. And then I suppose how it then evolved into a more permanent role with BTY post the role in Saskatchewan was I was asked to move to Calgary, which is in Alberta. Again, at the time, coming out of certainly a little lesser GFC that they saw in Canada, it's very much an oil-based economy, but very much the white-collar jobs in Calgary supported what was a very high-density and high-rise residential development, and a lot of suburban stuff as well I was involved in. And then, I sort of got across a lot of the major banks there, and saw that it wasn't just about providing consultancy services to these companies when I was in that space, but actually there was a huge environment and a huge growth potential with different roles across the built environment. And then that brought me over here nearly 10 years ago now.
So who are BTY Group, and what was the role that you were doing? Because that was your first official role, right?
Yeah, so they're a cost consulting company started out in Canada, and then they have European operations as well. I think they actually most recently had did a lot of work in the P3, PFI market in places like Turkey, the US. So my role was taking me into suburban Alberta, to hospitals in Saskatchewan, I remember doing some technical advisory work on a roads project in Florida for a toll road, because that's a similar kind of delivery of infrastructure was a huge part of their business. I think the one particular report that springs to mind back about 10, 11 years ago was focusing on the technical DD behind the Everglades that were adjacent to the major highway that was going in. So yeah, it's been quite varied.
So what is a cost consultant for someone listening to this who
doesn't know? They work on behalf. It's really interesting. It's a good question, because in the UK, quantity surveyors and cost consultants are much more well known and widely accepted as part of a project team. But still to this day, even in like localized markets in North America, people still go, well, why do I need that? I'll just go and ask a contractor. So generally their role is to provide professional advice relating to the cost and feasibility of a project, but also keeping things honest through the development phase. It's probably, you can split it into pre-contract and post-contract. And they're providing services to make sure someone's not overpaying as part of a construction drawdown process, or also that the bank is satisfied and you're their eyes and ears in the role I was doing. So that was really good, because I was across like 10 or 15 projects at one time. You're kind of the point person. Someone goes, what's going wrong with X, Y, and Z? And you're there as their sort of technical advisor. So you're the, I guess, project and project finance custodian, as it were. And
what skills do you need to have to be a really good cost consultant?
I suppose sort of similar to my kind of background in project management, you have to have generalist knowledge across all of what is happening on a site. So if I take some of the projects that perhaps weren't going so well for the developer involved, you're knowing that they might be overclaiming because they might have some cash flow issues. You know what to look out for. And then likewise, you also need to know that drawdowns are going to be dealt with swiftly because they need the cash flow. So you might be dealing with the bank directly and trying to sort of smooth the process, even though there might be allocating risk and looking at the other areas that the financier might have concerns about. You've got to be there to push back and also to encourage and make things work. But I think the major skill is just a really detailed knowledge of what goes into building a building, and knowing at a certain point in time you might be 45% complete, therefore that's what the drawdowns need to reflect. So you really need to know your detail on actually how the buildings go up.
How did your kind of role evolve, or what was the next stage from here? Because you moved into project management, right?
Yeah, so it was literally 10 years ago, probably to the day nearly, that I was kind of finally making the final decision on where to go, actually right before Christmas 2013. So I was contemplating moving to London. The market here was in good growth mode. Had a whole host of different companies. I sort of not purposefully, but as soon as I talked to really good recruitment companies like yourselves, and sort of realized that there was a number of different angles I could take. I could go into a pure kind of cost and project management consultancy, or I could go to a generalist agency that has a cost consulting and project management business, which is where I ended up. So I had 4 options, and I went with JLL. At that point in time, I wanted to be a bit more hands-on on projects rather than being part of a project team. So I decided to go with JLL, and I actually thought it's probably the best decision I could have made in terms of. Now I walked past, on my way here, I ran into an old JLL colleague. We did a little fist bump because we were both on the phone, which was quite funny. And it just shows, obviously, as I was based in Warwick Street for 4 or 5 years. It's really interesting because you get such a broad experience across these businesses as opposed to being sort of a point person for a particular skill set. I employed as a project manager for a particular project. So that was extremely helpful to my career. I mean, I deal with JLL on a sort of monthly basis, or certainly maybe even more regular than that, across agency, capital markets, land, etc. And I got a real broad experience from being involved in projects and that, because there might be working with the planning consultancy team on a particular project if it's a multidisciplinary team from JLL. So that was extremely hands-on.
And were you siloed into a particular sector at that stage, or were you working across lots of different sectors and lots of different projects?
Yeah, it's a good question. I did a lot of, across student housing, logistics, resi, and a little bit of single family. But mostly in that last sort of 2016, 17 is where I started working with a couple of core residential clients, and one of them being L&Q. And at the time, end of 2016, early 2017, they wanted to get in. They could see this thing, all these headlines about build to rent, and they needed some help through a planning application. So I was involved in securing consent with eventually the help of Sadiq, and finally they got on site relatively recently in a joint venture partnership. So that's a project in West London. And that was really helpful because it was a more strategic thing, because I was asking questions of, well, what do they actually want to do? How are they going to position themselves? So it was even more than managing a Gantt chart and a program and deliverables and meeting minutes and all the kind of fundamental points about being project manager. But it was actually asking more about the development side as to what's the product, how's it going to get delivered, how does it fit with your business plan? And that was something, once I got that exposure, I was sort of seeing that actually this build to rent sector is going to really kind of blossom. So in 2017, I sort of made the move on from JLL.
And so you kind of got some really good project management, UK project management skills and experience under your belt. You kind of identified this BTR market as a bull market, and wanted to kind of go after that. Oh, at that stage, what would you say your kind of core skill set was? Because obviously you had the financial piece blended with more of the kind of the project management and delivery aspect. Is that what your CV, or is that what your strengths look like?
I suppose at a point in time, yes. I suppose it was delivery, but also kind of acting as the kind of coordinator, conductor of a project. And I think at that point in time, I was possibly looking at, when you look at your sort of people, your colleagues that you're working with, and going, right, I'm at a senior project manager level. There's some very capable and successful project directors within that team, essentially doing the same function, not necessarily with the same experience, but the same function that I would be doing if I stayed in that role for 20 years. And that, to me, was like, I need to kind of think about whether that's something I want to do as a project management consultant. And certainly when you're in a consultancy, you always look favorably upon a client-side role, because it's sort of perhaps maybe a bit of a panacea that you're employing people like you to deliver the projects. And I think the reality was, I always kind of held that potential of find the right kind of client that meets with my kind of goals as well. So that felt like still a kind of maybe a medium-term goal at that point in time. So I was, I suppose, quite a generalist at that point in my career, probably quite young to have that general experience. But the international side I always thought was helpful. I mean, when you meet people and you can kind of talk credibly about your experience across 3 cities in Canada, really good to be able to apply it to a fourth when you come to London and have sort of 4 or 5 years work here. I mean, I genuinely, before I moved on from JLL, barely did much outside the M25. So it was really immersive to kind of continue that growth path into a business that was then growing in at the time was called Live Consult. And perhaps we can kind of get onto that.
Yeah, so you went from obviously JLL to Live Consult. Is that Cortland Consult now?
Yes, that's right. At the time, it was part of the Live Group, which was a Leeds headquartered property management company. And Live Consult was a standalone business established by Ian Murray, who remains involved in the business 4 years on from its acquisition by Cortland. So it feels like a bit of a whirlwind now looking back on it, but I joined, again, talking through the introduction, my involvement at the UK Apartment Association. If it wasn't for the UK Apartment Association, I wouldn't have joined Live back in 2017, because that's how I met Ian at annual conference. So you just never know where these sort of interactions come from. And we can maybe touch on exactly how we spoke, because it was actually through Twitter that I happened to be at an event, seeing the hashtag that was being used by, I think, probably just me and Ian in the reality, and who was engaging in that conference. Met him, had a beer, and within a month I was off to the races, find an office. Here's a relatively junior, fresh team. Good luck. and obviously Ian based up with his family in Scotland. There's some geographic challenges there. But if I go back to 2018, it was only a year, maybe not, it was in that first year that the conversation with Cortland were kind of beginning. And then the acquisition went through in August of 2019. But in that time, went from a core of 5 or 6 clients into Ireland with some of the leading developers there, and into Spain right before COVID. So that was a real whirlwind kind of couple of years right before COVID hit, and we were all thrust into working from home and working in a very different way. So yeah, it was very much known to be the kind of custodian of good market knowledge to create the optimal community. And one of the clients that I was working with was Apache and Moda. So Apache at the time was in capital raising mode, and I mean, a lot of these sites I was going around with my Live Consult hat on, seeing a blank piece of land or a site that needs to be demolished back 2019. And the reality is now that I'm on the client side with the team, seeing these buildings well occupied, driving good rental growth and performing really well for investors, it's quite nice to see that kind of full circle. And obviously now it's into asset management mode for the team, and we've gone from there.
So Live Consult, what was the headcount of that business, and then Cortland, and what was your actual role that you were doing day to day?
So Cortland. So at the time, Live Consult was a standalone business. So managing director was Ian Murray, and continues to be. And at the time, it was myself and 2 junior analysts, recent graduates, and that was it. And we had to find an office space, which was an interesting process. Sort of jumped around the city quite a bit, West End after the Cortland acquisition. But we were 4 people until we then grew and added 1 in Dublin, and then a second person in Dublin. And then it was successful in a very sort of white label standalone consultancy is profitable from day one, and continued to be profitable through COVID. And then obviously formed part of the acquisition of that Cortland made into the Live Group, which I might need to be corrected, but over 100 employees across different functions. And at the time, Liv was doing a lot of third-party white label operations for build-to-rent investors. And obviously that has evolved as Cortland has come in. They're now doing white label operations for investors here. In the US, they don't do that. They manage their own properties. But that business has kind of grown, got 3 or 4 good quality multifamily assets that have the Cortland branding on them, and then other assets where it's a bit more silent. It might be a branded building, but the Cortland core kind of business has then acquired further businesses since then. So again, I will definitely be corrected, but I would have guessed over 200 employees across different acquisitions over the course of the last 5-6 years. But its core function is predominantly property management for multifamily investors.
Was it a massive cultural change going from a massive beast of JLL to a 2, 3, 4 man business?
Yeah, exactly. It was, and I've said that to Ian even early days. It was functionally writing reports and being part of a team, whether it's a design team to create good quality designs for planning applications and ultimately onto site, to actually managing what does the output look like, what does the research and data look like that I need the data analysts to kind of put together. I mean, we were creating and building on the platform that Ian had established when he was a sort of sole trader in that business before he then sort of hired people in 2017, then hired me at the end of 2017. So kind of mentoring was a big part of that. And I think it's really good. I won't call out the two members of the team specifically, but both of them have gone on to, one's in a research capacity at a consultancy, left relatively, joined them about a year ago, maybe a bit before that actually. And another has gone to one of the large investors as an asset manager, and actually really interestingly, overseeing an asset very close to one of our prime assets and the Apache portfolio. So we exchange data on that, whether it's they're just about to open for leasing. So it's been great because I look back and go, right, 5 years ago, it was okay, this is the ONS, this is research, other research houses. We need to pull together a report for this outcome. And that was where we were 5 years ago. And now it's like they're on off and asset managing £200 million projects. And there's obviously, again, for them, it's evolving their skill set on that side. But I've stayed close to them, catching up for pre-Christmas drinks. It's really interesting to kind of see. I would say I've formed a little bit of the basis for really understanding the market, understanding the landscape, and both of them kind of sought my opinion on where they were going for their next roles. So that was pretty gratifying to kind of see where they've kind of taken things. But I think they both saw the potential in the multifamily market and to be forming a big part of their career. But I would say, yeah, it was a big culture shock. Small business at the time, it was just myself and one other in London. We were in sort of shared workspace, which was great. I must say that did a lot of more travel than I do now. So it was like hopping on planes to often get these sort of reminders on Google. 4 years ago, you were in Dublin taking a picture of a pint of Guinness. So, I haven't been in Dublin in a good number of years. So parts of it were sort of really kind of exciting and fresh and pretty cool. And when that market had the wind in its sails with both political and capital markets behind it to kind of see projects delivered. But I think the reality is clearly that market's getting a bit more difficult. So I think a little bit less work's being done by the consultancy in that space. But and then likewise, like at the end of 2019, getting into the Madrid market. I mean, I remember sitting in the Retiro Park with Graham Bates, the former chief exec of Liv, and we were kind of going, wow, this is pretty. I remember sitting there, wow, this is pretty cool. Right, it was about 2 weeks before COVID hit, and working with a client there who's taken a slightly different path away from BTR into sort of more service departments, but really interesting, kind of a really raw and brand new market. So. Yeah, it was great from that perspective and really kind of opened my eyes to what's happening sort of more Europe-wide.
So what were the kind of the core skills that you said that you picked up at Liv or Cortland Consult? You obviously had the analytical, the project management, and then what were the skills that you kind of developed or stacked?
I suppose it's, and now seeing what was a bit of a, I guess, a dress rehearsal in terms of presenting. So I was both tagged in to present to a number of different investors by the Apache team, and whether that's pitching or showing why a particular site is worth investing in. And we did secure the capital of KKR on this one particular transaction, but it was very much, I was relied upon as that sort of independent market font of knowledge, if you will, as in, why should we sort of sit me in front of KKR's investment team? Why should we go ahead and do this deal? And that was, it was a dress rehearsal, because then a couple of months later I was sort of tap on the shoulder, do you want to kind of join the team? I guess I got really quite good at understanding what the investors wanted to hear, and not necessarily just telling them not necessarily what they want to hear, but how they want to hear it. So I guess that presentation skills and distilling what is the actual market, I guess, indicators that we should be focusing on, i.e., what's the quantum of supply coming forward? Where's the affordability constraints? Why is this a target market? And actually kind of filtering that down and going, right, we need to be in these top 10 cities. And that confidence sort of brought things forward with Apache. And obviously we've got a huge portfolio now, which is great to see, having been involved in it from the get-go and seeing it actually having people enjoying living in the communities that we've funded.
So you got a tap on the shoulder. How did that come about? Who tapped you, and what was the kind of the role that you went into?
So the two co-founders of the Apache business, I was in for a meeting about how to support what essentially was a new platform with KKR. So I was sort of going, these are the kind of reports we could deliver for you at different stages. And then it quickly reframed the conversation back in the summer of 21. Obviously, a different environment, lower interest rate environment, and sort of precursor to that was obviously joining at the beginning of 2022, was things looked pretty rosy. So we were confident of a continued pipeline. So it was all about on-ramping that pipeline. And clearly that has become a little bit more difficult, but we have managed to get a good number of deals done in the last year or two. Certainly this year has been a pretty fruitful one for the business. But it's a really natural, wasn't like a sort of left field, do you want to come join the business? I've been working with them, sort of integrated into the team, sort of relied upon, pick up the phone to see what I've got to say about a particular opportunity for the lead up about 4 years. So I think to that end, it was pretty natural transition. Small, again, relatively small business, just mid-20s in terms of headcount in the business. So it wasn't like it was from a small business into a big one. It was just slightly bigger. So that was pretty easy.
And so they wanted your expertise in terms of understanding the market, the pockets of demand, product, location, in-house to basically help them inform their wider investment strategy, right?
Yeah, that's right. I mean, the current sort of senior leadership team within the exec at Apache is very subject matter experts, development, structuring, legal, investment analysis. But I'm definitely the person within the team that's sort of got my eyes up. I'm in the market. I'm hearing about opportunities. We're in dialogue with our peers and also with whether it's central or local government, sort of getting the best of what we can project and also receive and distill and understand, as well as obviously pulling things through, whether it's disposals or acquisitions, helping that and really understanding what we should be looking for, because obviously the business, when it was growing and it was only 10, 12 people, relied heavily on external expertise. So the kind of growth plan of the business is to have those internal experts so you can kind of thrust them in front of an investor, or whether it's a new partner. I'm kind of the point man on that.
So for someone who hasn't heard of Apache Capital, like who are Apache Capital? What is the business? What does it do?
Yep.
How's it funded?
So we're funded with predominantly family office capital, and we partner with global institutional investors to deliver multifamily and single family communities. So we've been going for 15 years now. The business was started by Richard Jackson and John Dunkley. Richard Jackson's no longer with the business, but Richard I've known for years and run into him at various events and have continued to have a good rapport with him. The business was started to unlock capital into undersupplied social infrastructure sectors. So initially care homes, student housing, and it kind of pioneered that highly amenitized student housing model that we see from a lot of the major operators. So initially the business was private equity led, Middle Eastern capital, and develop schemes to core, operate them for a period of time, and then dispose of them. Clearly within multifamily, it's been a bit more programmatic relationship with our development partner, and we jointly operate those assets with them taking the branded sort of customer facing piece, whereas we're dealing with a lot with the investors, but the asset management is very hands-on from those assets. So as we stand today in multifamily, we have a pipeline of 4,500 multifamily units, of which just over 3,000 homes will have been delivered by spring of next year. So that's pretty significant in the grand scheme of things in the UK. I think there was some headlines recently about no one's reached the kind of optimal 5,000 homes, but we're getting close, and it's a steady kind of growth path to get to that kind of level. And on our single family side, which is our sort of separate business called Present Made, that's focused wholly on single family, initially with a target of the Oxford, Milton Keynes, Cambridge arc. And that is predominantly where others haven't funded schemes. And we're on site with our first scheme there in Northwest Cambridge. So we're living sector specialists, and we work with domestic and international capital to deliver those schemes and operate them.
Can you just break down, and it is quite obvious, but for someone who doesn't know what BTR or multifamily is, what's the difference between that and then single family? And what's the difference also between for rent and for sale as well?
Yeah, happy to. I suppose to distill it in sort of physical form, build to rent is the kind of broad term for building apartments and houses to rent. I think some of the agents are talking about build-to-rent apartments and build-to-rent houses as being perhaps the better phraseology to use, rather not necessarily single family. Not everyone's a family, for example, so maybe multi and single family might not resonate in the UK that well. But in the US, multifamily is all apartment typologies that's invested in by institutions and by private individuals, as well as single family being, again, not to confuse matters, but has a slightly different phrase in the US. But single family here is single, your own front door. And in a multifamily built-to-rent apartment sense, you don't have your own front door. I think that's the best way of describing it.
And practically then, is one like a massive vertical tower, and others are kind of lateral towers with lots of different front doors. Is that kind of how you visualize it?
That's a good way of putting it, vertical and horizontal communities. I mean, we've got some very tall buildings in our portfolio, and then within our single family, we've got some apartments within that. It's probably a suburban built-to-rent community rather than potentially single family in the truest sense. It's probably somewhere in between in our first scheme in Cambridge, but we will be delivering schemes and communities that are all single family with your own front door. So there's probably some nuance in there. We're probably one of the few that actually has a scheme that fits in a bit of a subtle nuance.
So talk to me about, investor demand? Like, why is there such an insatiable kind of appetite from investors to access this sector?
It's really interesting because I think there's been a bit of a moment in time for single family where sales have slowed because of the economic uncertainty. That may release somewhat. We're not targeting sort of acquiring communities and houses off of house builders. We want to work in partnership to deliver high quality purpose-built product, maybe carving out a particular element of a scheme, maybe 100 to 150 to 200 homes, but it being in a very bespoke location within a master plan, not the leftovers. So there is capital for the leftovers and there is demand for that. I think the robustness of how long people will stay and ultimately the gross to net operating cost leakage is clearly probably a lot more controllable because you haven't got the wider costs around energy of heating a building. You don't have quite as high insurance, and you don't have as much staffing. So there's some subtle nuances between the two, but the capital seems to be in suburban locations because focused on that because the demand from residents is so significant because actually families are probably going to stay for longer, and there's data to prove that. So 2-3 year tenancies opposed to the sort of 12 to 18 month tenancies you see in urban multifamily. So that is helpful, but also slightly counterintuitive because in the urban sense, you get a bit more turnover, therefore you can capture inflation-linked rental growth.
Talk to me about the relationship with house builders and what is going on with house builders currently, because there's a supply piece in there as well, right?
Yeah, I mean, I attended an economics briefing breakfast this morning, and it was quite interesting. I mean, the phrase that they use, which I think needs to be adopted, there are a few local authorities that run and house builders actually. So it's quite a good blended kind of audience. The sort of supply side from them to investors is quite significant. I mean, we get tapped for 50 units here, 70 units there, and actually that's not that interesting because it does feel a bit like the dregs. What we're interested in is where house builders are, and probably to steal Savills' phrase, I think they're talking about a tri-tenure model. So part for sale, part affordable delivery, and then for a single family sort of institutional investor. I think that makes a lot of sense because if you can't diversify your capital, you're only going to deliver as many homes as you can sell. And I think that's the reality of the own door model in single family. You can drip feed into the market, or you can turn that on if you have the rocket fuel of something like Help to Buy has been for the last decade. That's helped prop that up. But I think it's quite clear that without some level of capital intervention from institutions, pension funds, etc., the housing that we're propping up that delivery as far as I can see.
And there's obviously like a massive shortage of new homes being built. What's the deficit and what's driving that, would you say?
Well, again, it's great that I've come to this. I can kind of crib this particular economist's view of things. What's driving it? Some immigration, pent-up immigration off the back of a depressed student market during COVID, as not as many people came here, as well as obviously record levels of immigration of people that we desperately need in this country because of obviously there was a hollowing out of foreign labour from Brexit, where people arguably weren't able to stay or didn't want to stay because of the environment that some of us created for the whole economy. So it's probably to say that the reality of whether it's the 300,000 target that the government have suggested, how realistically are we is it just a bit of a lofty goal? I think I'd argue yes. I think the reality is there's a great deal of supply that's left the buy-to-let market. Again, the veracity and the accuracy of that data, I would question, because it tends to be linked to who has got mortgage properties, and not necessarily all buy-to-let investors have mortgages. So I think there's two-pronged: increased demand from essentially a high level of new immigration, which generally enters the private rented sector first before it then chooses to buy a property, if they do. And then the reality of the lack of supply, or the trailing supply that doesn't necessarily, although the government does change its view on increasing energy efficiency targets, but doesn't necessarily find a taxational environment that is favorable to continuing to hold these buy-to-let assets around mortgage offsetting and that kind of thing. So I think the reality is it's going to be pretty stark. I won't repeat the number around rental growth that this particular economist described, but they were probably more pessimistic than us on the base rate, and also more optimistic, depending on which way you look at it. From an affordability standpoint, things are going to get worse for the private rental market before they get better. And from a medium-term perspective with a lot of operational communities, we look at this market and go, you know what, business plans can probably accept a slightly higher level, higher than where inflation will trend down to level of rental growth, which is probably quite surprising to us in our modeling. So I think it's going to be really challenging. And that probably leads us to a conversation on how high housing is going to be on the political agenda ahead of election manifestos, etc.
Talk to me about the product itself, because that's it's quite interesting. You've got like some super prime managed product and then not so super prime. Can you just talk to me about the evolution of that and how you rationalize that from a geographical perspective as well?
Yeah, I mean, the business set out with our development partner Moda to do super prime, as it were, or maybe not super prime, but prime in the regional cities. So that covered Glasgow, Edinburgh, Leeds, Liverpool, Birmingham, and Manchester, and Hove as well, which we're about to launch very shortly. So these are supply-constrained locations, ideally some of the best accessible, high-density, at-scale locations. 325 to 722 is our kind of sweet spot, which is very broad and very big. And that was designed to be the highest amenity, pushing the market in each of these locations, and we've successfully done that. Our focus outside of our Apache Prime portfolio is seeing how other multifamily and build-to-rent operators are doing things. Clearly, at our prime end, we have high level of staffing in the buildings. We put on a lot of events. The specification is better than some of our sort of mid-market peers. But I guess the crux of it is around the amenity provision. So the gym equipment, the gym space, the libraries, I don't think we've got pet spas, but I'll probably get corrected. But things like that, which are probably above and beyond anything that the local market has certainly seen. So it's designed to be the best community in each of the cities, and we've seen good, robust demand in each of those. And
for a user, who are you targeting in terms of occupying this type of space?
Well, we have some well-known celeb names that live in some of our buildings. Which is obviously interesting that they're choosing to live in a safe, secure, great environment. We do have a good chunk of key workers, NHS workers. We have private sector, people working in finance, banking. We have some teachers. We've got families. We've got people working all kinds of sectors. It's very broad, and even some retirees. We've got, I believe, and again, I believe it's somebody in his late 80s that have been living in Angel Gardens in Manchester since the building opened. And he's obviously very senior, but wanting to be independent, wanting to live in the city, wanting to live where the action is, and wants to live around younger people. Doesn't necessarily want to live in where perhaps his family maybe want him to be keeping a closer eye on him. So quite interesting. And I think that's the beauty about the rental market. The whole build to rent operating platform is looking across the spectrum of society that goes from 18 to 80 plus. And I think that obviously is generally focused on 25 to 34 year olds. That's where you have the peak of demand. But these are prime locations in the major cities that really we're seeing people enjoying living in a highly amenitized and highly service driven building, which again, as I said, differs slightly from some of our peers where they might only have a community manager and a handful of on-site management staff. We're talking about probably twice as many staff in the building, and therefore the rents and experience are commensurate with that.
I guess you track data, and that's really important, whether that's key fob access or cameras or what have you. Some of these schemes, and you'll know much better than me in terms of the price points, they seem extortionate in terms of being able to rent, but I guess there's a lot of additional value. You've got to be earning, either as an individual or as a joint household, a lot of money to be able to live in one of these.
Yeah, I mean, I can't speak for some of the London communities that you might be talking about, because those are 50, 60, 70 pound a square foot rental values. We're nowhere near that. So we're talking sort of early 30s in the regions. Yes, it's above median income, but we do have people that can afford to live in these properties, particularly cohabiting. You are unlocking someone who's on a median salary as a couple that potentially can afford this very comfortably. And the proof's been in the pudding on that, because that's exactly the kind of demographic that we have. We have single occupancy, people that have slightly higher incomes, all the way to double occupancy that actually want a 2-bed, and want the extra space, want the work from home space, and all that kind of thing. So I think on the affordability point, that's up to each individual investor to decide whether that's something that they think the local market and the data supports, that they can deliver something of that high quality.
Yeah.
But we've been quite comfortable, and that was obviously, I'm pleased that we've been so comfortable, because I was saying be comfortable 4 or 5 years ago with the data that's supported from a kind of underlying affordability perspective in Leeds, in Manchester, in Edinburgh, for example, where there's an unbelievable level of demand, particularly domestic and also obviously international. I mean, we have the best example. The little anecdote from when I went around our Edinburgh asset last year when it first opened ran into somebody that at the time Scotland was much more. I don't actually know what she looked like. She had a mask on, because Scotland was much more slow to unlock after the COVID measures were so in place there. And met her greyhound dog. Obviously, I think it's maybe slightly on the big side for the building. She just moved from Copenhagen. Literally viewed the property online, didn't visit it, and then sent all their stuff, and was delighted it was pet friendly, and was delighted that the amenities looked pretty good and the views looked great. To the average person coming in as a consultant into the NHS from afar, we were delivering something that, in that instance, Edinburgh hadn't seen before. And I think the reality is, it's great that we're able to do that, because it is even just fundamentally doing the basics of pet friendliness, no deposits, and a high level of service and amenity and security is really important to people.
Where does flexibility fit into it?
In terms of tenancy length?
Yeah.
I mean, we offer flexible tenancy length, but ideally with a minimum term. Those probably trending slightly longer. So generally a standard 12-month tenancies. We don't want to go just generally shorter than that, because you do have additional turnover costs plus voids. We're conscious of that. But I think inherently the service-driven build-to-rent model is flexible in it, because you're generally providing furnishing as well, and people can kind of walk in the room and go, here's my couple of suitcases. You can generally come with what you need, carrying it yourself.
Yeah, I guess quite a lot of corporate lets fit into that as well, right?
Yep.
And so you've got these fascinating kind of ecosystems of lots of different people, different backgrounds, different jobs, all cohabiting a particular space together.
Yep.
This year, cost of living crisis has been bandied around. Not everyone can afford that. There must be a market for a more kind of cost efficient or maybe not as amenitized offering. How do you see that, and where do you see that fitting into the market?
Well, if you take the US, for example, they have, and I don't really like the word class, like class A, B, and C is how they define things. A lot of what's been delivered is class A. And I think naturally that class A highly amenitized city center stuff. I mean, a lot of the product from some of our peers is still highly amenitized in a US context. I think where you get into sort of whole blocks owned by a housing association and maybe like the private rental arm of an L&Q, for example, is probably where it's sort of the bottom end of that level of amenity. I mean, we've got a great map of the sort of competitor analysis, and we think that our Apache Prime stuff is at the top right-hand corner of price and sort of price on one axis and quality on the other. And there's a great deal of depth of demand in more mid-market for sure. But if you're only one of one in a city, you've got great demand for that Apache Prime product, for example. So we're quite confident that there's some significant barriers to entry. To your point about cost of living crisis, that's obviously impacted the delivery of our buildings. If we were to need to build them again, for example, or try to build multiple in each city, that's a huge barrier to entry for incoming investors. So we're in quite a unique position to that end.
How difficult is it to get the operations right? Because one is investing, the other is like running these, and they're super granular, right?
Absolutely. I mean, my excellent colleague Jamie Snary is head of asset management operations, exec director. He's been with the business for I think it's 10 years in the new year. And he's been involved from the get-go thinking about how the buildings would be operated from 2016, 17, when the first asset started on site with Angel Gardens in Manchester. That was envisaged to potentially go a slightly different route where certain functions might have been used through a third-party operator. But clearly we wanted to drive value for the investors rather than necessarily think about the cost side of it. So we wanted to optimize what that resident experience was. So it was getting all the great, obviously it didn't exist at the time, getting all the great home view scores, getting the awards, and getting really people turning around going, we really like living here because X, Y, and Z. I think, we've definitely learned a lot. But I think from the perspective from our investors, we want to control the operating cost per unit, but also we need to balance that with optimizing net operating income growth, and ultimately seeing as a pretty unique proposition where we've got a big portfolio, and ultimately it is there to drive value.
Where does data fit into this? Because operating it as well as owning it must be phenomenal in terms of the data that you can grab and then inform the next investment decision, right? And investors must love it. Yeah,
I mean, we could always get more, but the data we have around who lives in the buildings, what amenities do they use, when do they use them, how much energy do they use, et cetera, we have all that. And it's really interesting to see the patterns of usage. And actually that's helping inform how we design some of our new buildings, and ultimately what our target market is. Because to your point about affordability, it may be that there's a deeper demand for a particular if we're 5, 7, 10 grand above the median income in Birmingham or in Manchester, it may be that for our next project might do a slightly different thing. But that data around building patterns and building usage, key fob access, and some of our sensors that we've got in the buildings, it's hugely powerful and actually quite unique, because it's only now getting into the market around informed design, because we're only now at the end of I would say the first, there's all these sort of different acronyms that people use or different numbers. People sort of BTR 1.0 was all the stuff kind of built 2014 to 2017. You're now only getting those buildings because of the situation with global capital markets. Those buildings are starting to trade because some people have to sell, some people want to sell. But the data and I guess the resident feedback that we can see from those transactions that are now happening is quite granular, in the sense of you might have a particular target audience. You might have, some of the schemes in the market, too many students, for example, so the yield might look slightly different. But again, if you can inform your next project because you've got really good data from the first one, that's where you want to be.
Where do you and where does the UK market look for inspiration, and who's further ahead on the journey? The obvious one is the US, but are there any other markets that we can look to?
It's quite interesting because 10 years ago, the ULI, what would have been way before that, because it's published 10 years ago, the ULI Build to Rent Guide was launched. It was actually the first ULI event, the Urban Land Institute event I went to, fresh off the plane, and immersing myself in Build to Rent at that point in time. There were a lot of visits to the US to go to garden communities, sort of suburban Build to Rent, and the high-end luxury ones with the pools and the basketball courts, et cetera, that was the inspiration. It's quite interesting touring an international audience around some stuff that we've delivered and funded, and they kind of go, oh, that's really interesting. Like, I had an Australian group over in May, and they were like taking tons of pictures, going, oh, we don't quite do it. Like, oh, but that's exactly the same as what we do in this particular technical detail. It's been quite interesting that I think the UK market has actually kind of set its own kind of tone and pace for things. And I think I genuinely don't see any community that, there's some things you go, they should fix that, or that looks a bit dated or whatever, but it's all going very, very well from an operating standpoint. There's no sort of standout, oh, that's not really working. So I think we've kind of found our own path. Obviously the inspiration comes from the US, but the two kind of ULI guides were kind of in 2014 and 2016 were kind of the industry Bibles for delivering projects from a design perspective. But I would say when you look at the Irish market, they definitely tried to learn, having been a consultant, UK consultant going to Ireland, like, what are they up to in Manchester or in Leeds or in London? And they come over and go, oh, actually, we can take bits of that and kind of deliver it. But obviously a slightly smaller market in Dublin than some of our two major UK cities.
What are the biggest challenges in the market right now that you're having to navigate as an individual, but also as a business?
Good question. I think as an individual, I think talking to our peers is always really good. Hearing that there's certain people that might be moving on from a certain role or might be finding market really difficult. And sometimes you just like people pick up the phone randomly or you run into them on the street. And actually just sort of talking, I think that is an important thing, because how are people navigating it? What rate did someone get on a particular investment refinancing? Who's a good lender to deal with? You feed all this back. So you're all talking in the background and having some really good sessions with some of our peers. I mean, I went to one lunch recently it was the probably 10 or so multifamily sort of investment guys and ladies. And I think the critical thing with that is you're hearing stuff, you're seeing press releases, well, like, what's the detail behind that? Or how did that really work? And actually that has informed how people are being flexible about transaction structures, but also what the long-term strategy is for a particular asset or a portfolio. And I generally find if you give a little, you get a little back. And then for us as a business, clearly it's a challenging refinancing environment. In terms of sort of headline numbers, both equity and debt, we've done £1 billion worth of capital transactions this year. We've just refinanced a couple of new assets, which is great. Clearly, it's a lot less favorable in terms of rate than it would have been. But we're sort of seeing this as a bit of a choppy waters to hopefully things being a bit more stable into 25. So from that perspective, we've managed to, I would say, navigate it really, really well. And clearly, take stock of what's happening in the market. There are some motivated sellers out there, and that's having an impact on where yields might be positioned and ultimately how the market might be seen. But we'd like to see a continued level of liquidity, because that's only beneficial to continued capital flow.
As we draw to a close, what are the kind of things you're most excited about as you kind of take a bit of a step back and look across this residential or this living landscape?
What am I most excited about? I think the natural evolution of certain house builders to delivering suburban multifamily products, single family product, I think is probably the thing I'm most excited about. And I can feel and see that at a sort of granular level, because we have a family friend that lives in a prominent branded single family platform, one of their communities on the South Coast. And there's sort of little things that they'd like to fix, but overall, compared to the wider private rental market, it's great to hear. She's got a family of 3, really happy, enjoying their big garden, big house at slightly above the market rate she was paying before, but she's really happy. And it's really nice to sort of hear that's really tangible for me personally, because you see these who lives in build to rent reports from Dataloft and from the BPF. And I think the reality is unless you sort of know someone who lives in it, it becomes a bit more real. So I'm really interested in the growth of that market, and obviously, as a business, we're really well positioned to be utilizing our investment capital to deliver a lot of houses in our target markets. I think the reality of the current economic situation for the next year, probably more likely 18 plus months, will drive a lot of house builders to use the private capital and pension fund capital that they can access to continue to have their schemes funded. So I think that's where we see a lot of energy and focus for our business going forward, as well as obviously continuing to operate some exceptional prime communities in our portfolio.
Can you just talk to me about the ULI and also networking as well? Because I think we started at the top, just in terms of a little bit about networking, the value you place on that. Can you just expand on it further? Yeah,
as I said, 10 years ago, the first event I went to was a ULI event. I think it was at the near the Royal Albert Hall, one of the adjacent kind of auditorium type things. And I was like blown away, because it was a hugely diverse audience on the panel. But really interestingly, the only reason I heard about it is because a client of mine in Calgary said, "Oh, you're moving to over our Christmas." It was literally 10 years ago, our Christmas party, and he goes, "Oh, you're moving to London. You should get involved in ULI. It's just starting." At the time, it was, I think, maybe 500-600 members. But ULI is generally seen as the sort of benchmark for multidisciplinary. So you've got clients, investors, lenders, architects, planning consultants, the whole bandwidth of the built environment. and even local authorities, etc., and central government coming together and having specific topics to talk about. And actually having the outputs of actual research and thought leadership. So hence what I was mentioning earlier, the Build to Rent Guide, which was a collaboration across sector, launched in 2014 and then a second edition in 2018. Since then, there's been other outputs, which include Housing with Care Guide in 2019, and then more recently a co-living guide for Europe, which was very well received. I think the critical thing, and we actually had our residential council we call it a Winter Product Council Day last week, at Greystar's building Bloom in Nine Elms, which is a phenomenal multifamily high-end scheme, along with the pools and everything else. So very impressed by that. And the point of that discussion, we were talking about the co-living demand and build-to-rent demand. So it was great. We had a operator of co-living, operator of build-to-rent, and we had local authority there, we had architects there, all in the panels all talking to each other. And actually hear from a local authority going, these are his gripes about affordable housing and what we're providing in build-to-rent or co-living communities. And then you're also hearing from a planning consultant going, well, the reason why we have to do that is because we're cross-subsidizing. And if we didn't have to do that and you guys were delivering council housing directly, maybe that would be a bit of a different scenario. So what the point of all that is if you actually have a Chatham House rules discussion, so you're all keeping these things sort of within the four walls that you're having those conversations, you drive forward the conversation, so you're not talking about things in silos. So I think that's the biggest thing. I mean, I've been involved with ULI UK for nearly 10 years, so I came in as the young leaders, which is up to 35, and also I was heavily involved in the growth of the European young leaders back in 2016, 17, and then took a bit of a step back towards as COVID approached. But for the last 5 years, been focused on the Resi Council, and I want to continue to grow that.
How do people get involved with it?
People can drop me a line. There's a new exec director of ULI, Ben Collins. Obviously, he's driving things forward from a senior leadership perspective at ULI HQ. But I'm always happy to help people out with pointing them in the right direction. Keen to see 2024 have a bit of a focus on some core areas, which I'm happy to talk about directly.
So look, as we draw to a close here, a question that I ask everyone on the podcast is, if I gave you £500 million of capital, who are the people, what property, and which place would you look to deploy it?
So I thought a bit out of the box on this one. I golf. So I've been a golfer for probably 30 years since I was a little lad. So I'd love to do golf course design as maybe a hobby when I'm much older. So a sustainable golf course with hotel hospitality, ideally potentially near the coast, so you could maybe harness some tidal energy, have it net zero. And I've one particular location in mind because I like North Berwick, right in the core of a little town. Which has the lovely pubs, the B&Bs, etc. So probably just something like that. Buy the whole thing and operate a golf course. Purely from a selfish perspective, because I'd love to have a golf course.
Highly amenitized, highly efficient, highly operational. Lots of different mixed uses and classes in there.
Exactly. And it's been really interesting, sort of why golf. I know that there's one rather prominent architect who I know well has been opining on the future of golf courses. I don't disagree, because I think they're a very inefficient use of land, particularly inside the M25. But it's really been interesting. I live very close to the O2, and they have a great facility there, which is only temporary, a driving range there. Pre-COVID, it was full. It was a Vinoteca wine bar, and a certain demographic of people went there. It was pretty quiet, actually, generally. Now it's a burger bar with good beers on tap. And you can order to your table, interactive stuff. I think adding that to that mix, maybe that wouldn't go well in a rural Scottish setting. But the really interesting thing there is you've got an incredibly young demographic that is playing golf, not necessarily going to playing 18 holes, but they really like the gamified fun that you can have on a driving range. And if I tried to book this evening, I couldn't do it. That's how busy they are. And it's a credit to that business, because they kind of turned it around from what I don't think pre-COVID was particularly profitable, but they're packed out. So I think that it's a great sport, and I do enjoy the kind of corporate side of things from a golf perspective, and you do meet some really good people, and some of your investors are out there as well. So that would be a really good, probably slightly selfish, but you could add the homes and the supporting services to drive kind of the economy as well. And
the people you bring on the journey, get Jamie along for an operational perspective.
Oh yeah. Get Jamie, maybe not for his golf, but there's a few decent golfers in the Apache team. So I'd pick a very select group.
Good stuff. Well, look, Ashley, thank you so much for joining me on the podcast, telling me a little bit about your background story, views on the market, breaking down some of the jargon that we all come across and we all hear, and laying it straight in terms of what the future looks like and where the opportunities are. Hopefully you will be named Ashley Podcast Perry, or maybe it's Ashley Panel Podcast.
I don't know.
Perry. Don't know if it's going to stick.
It doesn't quite sound that good.
Well, look, Ashley, excited to see what you and the wider Apache team go on to build and take advantage of the opportunities moving forward.
Thank you very much.
Thanks for listening to this week's episode of the People Property Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People Property Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.